if you believe America is going to survive, apartments will be an important part of that, and we will continue to thrive as well.
Welcome to Ritter on Real Estate. I'm your host, Kent Ritter. And as we all know, these have been trying times. We're all hunkered down. We're sheltering in place. And on top of that, many of us have seen our stock portfolios wipe out years of gains in the past couple of weeks. Luckily, I've diversified my assets into other things such as commercial real estate. And I think the question is still out on how commercial real estate is going to perform, right now based on where we're at with COVID-19. So I wanted to bring on an expert today to get some perspective and help us get our arms around what do we think that impact is going to look like and what we can expect into the future. So I've got Tag Birge today. He's the CEO of Birge and Held Asset Management. Birge and Held has acquired over $1.2 billion in assets under management, including 11,000 apartment units. So they're not only large owners, but they're also completely vertically integrated. So they've got internal property management and construction management as well, which I think gives them a really unique perspective from the ground up. So we're really excited to have Tag here today. Tag's been in the industry for a number of years. He's well tuned into what's happening, not only through his own portfolio, but in the capital markets and broader. So excited to get his perspective. And with that, thanks, Tag. Thanks for being on today. And,
thank you, Kent.
Yeah, we're excited to get into the conversation. So let's get started. So let's just start at the top. I mean, obviously this has been a large disruption to your business, but where's your head at right now? And what are you focused on as you're working through mitigating, what's happening with the coronavirus?
Well, first, let me just say that anybody who's dealing with this right now has to be focused on the health and safety of their employees and obviously the tenant base that we serve. We believe that the apartment industry is going to survive and thrive through this. I do think that there's going to be significant disruptions in the commercial real estate industry. The way I usually think about it is, are you a demographic play or are you a GDP, gross domestic product play? Mm-hmm. And clearly apartments, with more and more people moving into apartments being an essential need, is a growing demographic play. I think apartments are going to fare well coming out of the next 90 to 120 days. We will certainly have our challenges in the industry, but coming out of it, I think we'll do better than other groups such as hospitality, retail, entertainment, because there's inevitably going to be some contraction in the economy once we come out of this shelter-in-place world.
Mm-hmm. Yeah, thanks. And how do you see asset class as you look at different asset classes, A, B, C? Do you see a difference in the impact based on the asset class, or do you anticipate a difference in the impact? Do you expect some to fare better than others?
It's a great question, Kent. I mean, we're really in uncharted water. I think that you could see some movement down from the A to B. I mean, if you look at the last decade, obviously most of the product that has been built has been A class. We still have an incredible affordability crisis going on around America. I think you could see some migration from A to B because some of the A folks were maybe stretching for those $150, $2 a foot rents. And B product, the Midwest, is more like $1 rents. So as people try to repair their balance sheet, I think you could see some migration. In the short term, if you look at the stimulus bill, folks who make $75,000 or less, which is 99% of our occupants in our kind of B workforce housing product, those folks are going to get a check. I'm not completely up to speed with the legislation, but I think it's going to be somewhere between $1,200 for an individual and up to $3,000 for a family potentially. And so there is going to be some immediate relief put into the tenant base of the workforce housing. If you're making over $75,000 and you've lost your job, I don't think the stimulus bill is going to cover those folks. So they may have just as much stress with less government intervention.
Mm-hmm. And that's a really good point. Really good point. So what are you guys doing as a team to help to assist your tenants and to mitigate the bad debt that potentially could be coming? I mean, what have you guys put into place as kind of your mitigation strategy?
Well, I mean, I think like anybody right now, it's about retention of the folks that you can hold on to. I think there's going to be less movement in the apartment industry the next 90 to 120 days. Typically in our B workforce, 40-50% is the turnover that you would expect. We are really focused on trying to provide folks with a place to stay so that they're not motivated to leave. We are instituting a $50 discount to anybody who pays before April 5th to give folks incentive. And candidly, we're going to work with people who are hurting, who've lost their job. It's no secret that people in hospitality, retail, restaurants, which is disproportionately represented in the B workforce, have lost their jobs, either have been furloughed or laid off. And we're going to work with those folks on a payment plan. And right now, we're contemplating a no eviction policy for folks who have been good payers, who can document that they have been laid off and are willing to sign a promise to pay agreement with us.
Oh, yeah. Well, I think that's great. I mean, it's a great service for folks. Obviously, there's a certain amount of humanity in all of this, right? I mean, it's a business we have to run, but at the same time, and we're dealing with people's lives and where they live. So appreciate that perspective of being able to work with folks and, help them through the process. I know also Fannie and Freddie have come out and said that they're going to offer, certain incentives, right, for operators as far as furloughing loan payments and things. If they follow certain requirements, I mean, do you see that having, I guess, how has that changed your perspective? Is that
I would say
drastic?
That,
yeah, go ahead.
We're really in uncharted waters with COVID-19 in terms of how quickly it's impacted our workforce around America. And I think Fannie and Freddie are probably looking at lessons learned from 2008. I think our country is in a better position for this crisis, which is both a humanitarian and health crisis, but could also quickly turn into a financial crisis with banks pulling back or foreclosures rising. And what I'm seeing is a kind of an attitude from the financial sector that we're all in this together. I worked in commercial real estate in 2008, and I can tell you that was not the sentiment. It was kind of us against them, the lenders and the borrowers. And I'll never forget in '08, a week after the financial crisis started, lenders sending out technical defaults and loan-to-value covenants. To me, this crisis feels completely different, and Fannie and Freddie are two of the groups that maybe are evidencing that by the fact that they just announced yesterday that they're going to modify their notes to have a forbearance agreement for up to 90 days with landlords who agree to a no eviction policy. We were already looking at a no eviction policy. I think Fannie and Freddie, who is a disproportionate lender in the apartment world, we use them extensively, is really smart to take this. It'll give landlords breathing room to work with their tenants, to have a passion for people, which is one of our core values, without the financial pressure bearing down for at least 90 days. And I think everybody is hoping that the country is open for business in 90 days. And so they've really are in the process of giving landlords around the country breathing room to work and help their tenants without the mortgage payment bearing down imminently.
Mm-hmm. Yeah, hopefully that's like you said, I like that perspective of everybody's taking their lessons learned from 2008. And it does feel like we are financially in a better situation. But I think, like you said, that could turn if things aren't handled correctly and if we don't take the right action now. So, but it's good to hear that it sounds like at least we're not going to relive past past issues, and we're learning from our mistakes. So
I would agree with that. I think one of the other significant pieces is that the body that regulates banks, so there's a lot of banks that are out on bridge loans before permanent financing in the apartment world. They came out with guidance yesterday to work constructively with borrowers. And more importantly for the banks, they've said that if you modify or forbear a note, it's not going to be classified as bad debt for the commercial lenders, which means that they don't have to reserve against it, which means it gives the lenders a lot more leeway to work with folks who are distressed borrowers without impairing their balance sheets. So that was very significant in addition to what Fannie and Freddie announced yesterday.
Oh, very good to hear. Yeah. So not classifying it as bad debt means, and not having to reserve against it means they can keep more cash flowing. And it allows them, right, they don't have to freeze up and increase their requirements. They can keep more, not that loans will flow like they used to, but at least keep the cash flowing, right?
Exactly. I mean, there's no requirement for them. When you have to reserve against bad debt, you're pulling liquidity out of the banking system because you're forcing them to park on the sidelines. And because the regulatory bodies have said that's not the case here, there's going to be more liquidity for banks to help borrowers either with lines of credit, reworking loans, making new loans. And again, I would tell you that is a direct result of the lessons learned from 2008 when the regulators did not give an inch to the banks. And so even if the bank wanted to work with the borrower, they were forced with the decision between having to reserve against that loan long term, pulling liquidity out of their system, or helping a borrower in need.
Gotcha. Well, this is very cool. I really appreciate your perspective going all the way back to 2008, that you've been through it and seen how this has evolved and can understand the differences. So I think it's this awesome perspective that you have here. This show is really about the investors and how do we make smart investment decisions in real estate. So what should investors be thinking about as they're evaluating investments in the post COVID-19 world? So how should investors be changing their perspective, or what additionally should they be taking into account as they look at investing their money?
That's a great question. I believe that there will be, once we get through the next 90 to 120 days, there will be more interested investors in hard assets. Hard assets being, alternative real estate investments. I believe that there will be a focus on what are essential areas of commercial real estate, residential real estate, and what's going to grow. And I happen to believe that healthcare real estate, I think, will do very well. There's more money that's going to go into healthcare real estate, both the hospitals and the outpatient setting. I believe that industrial real estate will do very well. I think we're seeing maybe a fundamental shift accelerated by the stay-in-place orders where people are ordering more online. And I believe apartments, which traditionally have served as a shelter in the storm, if you will continue to do well. There is a demographic move, I should say, into apartments. More people are going to be renting. Less people are going to be buying. There continues to be government intervention, both helping the tenant base and the GSA, government service agencies, Fannie, Freddie, and HUD are all leaning in to help people. So there'll be lots of liquidity there. And it's not GDP driven in the apartment world. It's just a long-term demographic play. And the affordability crisis is not going to go anywhere. And then lastly, I would tell you, with the $1.6 trillion that we're getting ready to drop on America in various forms, at some point, inflation will rear its ugly head, and apartments are one of the best hedges against inflation because the rents reset every 12 months, and the assets are basically take commodities to be built. And if you have inflation, commodities are one of the first things that rise in prices. So you have the ability to reset rents every 12 months, ability to lock cheap debt long term, and ability to raise rents in a normal economy when there's inflation. So I think there will be more interest in hard assets, and I think apartments will be one of those areas that continues to gain interest from investors looking to diversify their portfolios away from just financial assets.
Mm-hmm. Yeah, and I imagine that there will be, like you said, that interest coming. I know I'm hearing it from my friends who have been kind of toeing in the water on real estate, that taking another hit on the stock market has been pretty painful, and they're starting to ask more questions. So I agree with you. I think there's going to be more of a focus there. As people are. Do you see underwriting as we're evaluating deals? Do you see underwriting changing? we always talk about conservatism and needing to build that in. Do you see an extra level of conservatism that's going to need to come after this? Or do you think, I know it's impossible to predict, but in 120 days or when the virus passes, that the market will largely return to normal?
I think there will inevitably be some disruption in the marketplace, and I think there will be an assessment of which areas of the country held up. Was it A, B, or C that held up the best? I think typically after you go through a crisis, underwriting tends to lock down, particularly with the commercial banks. They get more conservative. Mm-hmm. But the one thing I would point out to you and your listeners is that 50 to 60% of the apartment debt market is not commercial real estate. It's Fannie, Freddie, and HUD. And if you go back to 2008, in order to bring stability to the marketplace, because apartments are a key need of humanity, a place to live, the government actually relaxed the underwriting requirements to make sure that there was still capital flowing in that space and to bring more stability. When you pull the liquidity on the debt side, which is an example will be hotels, there's going to be no liquidity, no debt, no banks lending into that. You bring more disruption into a space. And so I do think investors maybe are going to be more conservative, but there's a chance even after this next 120 days that you could see the government-backed GSAs and HUD leaning more favorably into it and maybe even relaxing requirements to bring stability to the space, just as they did in 2008.
Oh, really interesting. Yeah, that's counterintuitive to what I thought, but I can see how that makes sense. So if you're looking at the long-term impact on multifamily, I know we've talked about this a little bit, long-term impact on the apartment industry as a whole. I mean, go out a year, 2 years. Do you predict at this point that things will be different, or do you think that there's kind of a normalization, over time where things return back to a status quo? I mean, do you see, I guess to be more specific, do you see cap rates continuing to move down at some point or up, and do you see interest rates going up or down? I mean, what do you think after we get through this initial bump as things kind of normalize? How do you think things return?
That's a great question. At a macro level, I think what you're going to see is less housing starts because the consumer confidence is going to be hit pretty hard through this process. So you're going to have less alternatives to apartments, less affordable housing starts. I think you're going to see less Class A building. I think you're going to see more building towards the affordable side of the world. People are going to wake up to the fact that we've overbuilt in the Class A kind of high-income urban setting, and there's going to be more interest in the suburban affordable as people try to repair their balance sheets. With the 10-year Treasury below 1%, typically apartments have a 300 to 400 basis point spread in terms of their pricing. I believe that we will be in a low interest rate environment for the next 12 to 24 months. I think there'll be a search for yield, a search for hard assets. And so I think cap rates, once we get through the next 120 days, next 4 months, take us out 18 months, I think they will be at a 5% or lower for the medium cap rate around the United States as people look for yield, look for an inflation hedge, and see that the B workforce will probably hold up very well. People moving from A to B, and the fact that the government is getting ready to have a major intervention for the first time in one of these crises in the history of the United States, putting money directly into the pockets of the majority of those renters.
Gotcha. That's great. So yeah, I mean, it seems like as we look for places to invest, I mean, obviously you're making the case for apartments, understanding that everybody needs a place to live, right? And as we look at that, I think it's great perspective on taking a look geographically on which parts of the country were hardest hit, taking a look at asset class, which asset classes were hardest hit and which ones will stand up, and seeing that surge to workforce. I mean, I think that makes a lot of sense. And I mean, hopefully from an investor perspective, that will continue to open up opportunities for folks to get into those properties, get in those deals, and like you said, that search for yield, be able to capture some of that cash flow. So hopefully, silver lining coming, if there is anything coming out of all this, as we look 6 months, a year down the road, hopefully that means there are good investment opportunities to be had, and allow folks to continue to diversify. So
we believe that it will definitely be a favorite asset class when we come through this.
Yeah. So you probably have, I probably know what you're going to say, but I just want to ask, so coming out of COVID-19, as we look beyond, are you going to be a net buyer or a net seller as we move into the next phase here?
I mean, we continue, because we're bullish on the space, we will most certainly be a net buyer as we build out our portfolio. Our goal is to aggregate at least 20,000 units. We're at about 11,000 units right now. We continue to look for opportunities, and will continue to look for opportunities to rehab and reposition kind of B suburban place, and then keep the rents affordable to folks who make $35,000 a year. Affordability, as defined by HUD, is not more than 30% of your gross income going to rent. And our average rent is about $850 a unit across our 11,000 units. And so our units remain affordable, as defined by HUD, to anybody who's making $35,000 or above, which is a large swath of America.
Mm-hmm. That's a good point. You just made me think about something, because I look at a lot of deals. I look at a lot of underwriting. I see rent projections, 3%, 4%, 5% year over year rent growth. So people have set up a lot of deals with projections that's going to continue. That's going to, those are 5-10 year trends, right? How do you see rent growth being affected coming out of this? Obviously, I would assume that rent growth slows as people are figuring out, what they can afford, and people are going to be looking for jobs that are coming back in. But what do you think about that, and is that going to be one of the biggest breakers of whether these deals pencil out, is how rent grows? Or what are you seeing? I guess that's the first question. And then if not, what are you seeing being the biggest impact of whether these deals are hitting their pro formas or not?
Well, I think there's no doubt that underwriting going forward for the next 12 months is going to look at the income in place. I think you and I both know that there's been a lot of forward-looking underwriting that assumes 3 to 5% rent growth. I would take that off the map for the next 12 months. People are going to be looking at the stabilized rent and how durable the rent roll is. And I don't think folks are going to underwrite a lot of growth until we get at least 11 to 12 months, because we are going to have some quarters of slower economic activity. I think for every month that we're under a shelter in place, you're pushing back the ability to grow rent by 6 months. Rent. We will have rent growth again. We will have inflation. It's just a matter of how quickly the economy can get reassembled, if you will. China is a great example where they are up and running 60 days after a virtual shutdown. And if we can do that, then I think this year will be flat. I think next year we'll see rent growth, and I think you'll start hearing the drumbeat of potential inflation with all the money the federal government's getting ready to drop into our economy. Right now, we just need to get through the next 120 days. Right.
No, and that's great perspective. And like you said, bringing up inflation, we've been in an environment where there has hardly been, inflation's been very low, right, for the past 10 years. So you're thinking longer term, it could actually push inflation higher, which would mean higher rent growth as rent moves with inflation over the longer term. So what I'm hearing, yeah,
I would agree with your comment, Kent, that inflation has been low, but three kind of core areas where you've seen it have been housing, education, and healthcare.
Okay.
And I think you're seeing housing inflation primarily in the affordable space. Rents have been going up 3 to 5% because there remains just this incredible crisis where demand far outstrips supply. Right. Folks looking for that affordable housing piece.
Right. So if I can if I could sum up what I'm hearing from you from an investor standpoint, it's the core fundamentals are still there, right? If we take things back to supply and demand, there is still quite a bit of variance between the amount of supply that exists in housing and the demand for housing. And as we get through this, I mean, that's not going to go away, right? Right. The number of people are still there. They still need houses. In
That's
the
right.
short term, though, there's the idea, the focus from an investor standpoint, I would think should really be on stability and on, focusing on operators that are being realistic, operators that have the means to manage through the process and are taking the appropriate steps to maintain occupancy, right? I mean, I think that's really what's important right now. So managing expectations, I think our own expectations a little bit about what's going to happen in the next 12 months, as we look at distributions and things. But then as we look into the future, we don't know how long this is going to last, but as we look into the future, it does seem that we will return to, the fundamentals, to rent growth. We expect, we're hearing Fannie and Freddie and the commercial banks are working with us and with the operators to smooth things out. So hopefully avoiding an issue like 2008. And so from there, it seems like the long-term prospects are still strong for commercial real estate. And I know you called out some particular sectors such as healthcare and apartments and industrial that folks should be looking at. So is that a good way to sum things up? Did I catch anything or anything else you'd add?
No, I think you summarized that
very good.
Very
well, last question I have for you, in everything that happens, there's obviously lessons learned. I know even a mature business like yours, I'm sure there's things that you're saying, man, next time we're going to do this better. I mean, obviously nobody expected the shock that we've had right now, but what's the one big lesson learned you have at this point, and what can you implement into the future to make sure that we're learning from this?
Well, I think, everybody has to be creative and more imaginative about what the worst case scenario could be.
Sure.
If you would have asked me 12 months ago, is there any scenario where a virus would shut down the United States of America? I would have told you, no way, never going to happen.
Right.
Possible.
Right.
And so I think everybody needs to think about their contingency plans in this interconnected world for pandemic diseases, and what you want to do with your staff, with your tenant base, with the amount of liquidity you want to have on hand, with the duration of your loans, and just build a more conservative analysis based on the fact that black swan events such as a pandemic do happen. Mm-hmm. And you want to make sure that you're in a position to survive and thrive when the inevitable revival resurgence occurs, which, the great thing about America is that we are the most flexible, most entrepreneurial, most durable economy in the world, and we will come out of this quickly once we can get back to work.
Yeah, no, I think that's great. I think the idea, right? I think there's been other pandemics in the world, right, or epidemics at least, and America has largely been untouched since. I mean, you go back to maybe the Spanish flu, and now it's a reality. It's a reality for us, right? And so I think that reality check is great. I think that goes back from an investor standpoint to, stress testing models, right? And stress testing that to, like you said, redefining what is a worst case scenario and how are you preparing for that, right? Or how is your operator, how are the deals that you're looking at, how have they prepared for that? What are their reserves that they're putting into place, right? What are their contingency plans? Mm-hmm. And how much room is there in the deal, right? Because I know that, if you're in a situation where your debt coverage ratio is so slim that you can't lose 10% of your occupancy and still make the mortgage payment, right? Those deals in today's day and age. I mean, in today, right now, those deals are going to be, they're done. I mean, they're going to have to happen. No, they're not going to happen, or the people that are already in them are going to be in trouble, right? So making sure that their deal has enough room, making sure the stress testing is happening, and making sure that those contingencies and reserves are in place, I think are some good lessons learned that I take away from that tag. Well, awesome. Well, Tag, I really appreciate your time today. I mean, I think this was fantastic perspective. I think just hearing again, I think it's a little bit settling for me to understand that in the long term, we think that things will return. We think that, apartments and other sectors of real estate are still good investments. The underlying fundamentals haven't changed. This is just a large shock, and it's really going to be what we do now as operators to come out of this, as best we can and mitigate on the other side. And like you said, be prepared to act on the other side when the deals do come back and things do settle down. Right. So
absolutely. It's going to be a great space long term. If you believe America is going to survive, apartments will be an important part of that, and we will continue to thrive as well.
Great. Well, thanks, Tag. Thanks again for your time. As it's always a pleasure to speak with you, and hope to get you back on the show again.
Thanks, Kent. Great to see you, buddy.
Thanks.